and welcome to the Q1 2024 Astute Investment Management Quarterly Market Update. I'm Hannah Owen, Head of Group Communications, and I'm joined by Dr Scott Osborne, our Chief Investment Officer. So Scott, the first question I've got for you, this is the update for Q1 2024. So first of all, could you cover how the end of 2023 went?
Yeah, so it was a pretty eventful end to the year, right? I mean, 2023 as a whole probably didn't feel that great. Most of the year felt a lot like 2022. We were really worried about inflation, we were worried about interest rates, bonds were losing money, equities were doing okay, but it was patchy. But then a lot happened in the last kind of 6 weeks of the year, and that's really where we got most of our returns. So actually, if you had just ignored your portfolio valuation and news and everything and just gone on holiday for a year, you just looked at the returns at the end of 2023 and thought, actually, we had a pretty good year. I think, double digits on our growth fund, mid to high single digits on the other funds, outperformed our benchmarks, outperformed our peers. That's a pretty good year, but it did not feel like that up until the last 6 weeks. And basically the reason for that is that it wasn't until the November, December period that markets really started to think, actually, we've got inflation under control, and we are going to get these interest rate cuts next year. And that is when they started repricing everything, because it's kind of like that big worry, which we talked about for way too long now. We've been obsessed with inflation and what central bankers are saying. Finally, the sort of penny dropped in. It was like, okay, we do not need interest rates to be 5% in the UK or the US this time next year, so the end of 2024. We just absolutely, there's just no need for that, given the trajectory that inflation is on. So how many interest rate cuts will there be next year? And straight away there, you flick the switch in the markets to say, we're no longer worried about rates going up. We're starting to think about how and when they come down. And that change of sentiment and change of mentality led to a big market rally in basically the last 2 months of the year. And we benefited a lot from that. Obviously, bonds were a principal beneficiary, because basically as you take those interest rates out of prices, the cost of borrowing money for governments comes down, so those yields come down. And as yields come down, bond prices go up. And actually up until the beginning of November, government bonds, basically UK, US government bonds, were underwater on the year. They were losing money. But by the time you got to the end of the year, they'd made 6 or 7%, which shows you just how strong that rally was. And in all honesty, we thought that would come sooner. We expected markets to kind of get to that point sooner in the year. So it wasn't comfortable waiting that long. But the fact that we're kind of there, and like I say, the penny has dropped, it's a bit of a relief. And we were kind of positioned for that. So we relatively benefited, where some of our small cap exposure relative to large cap outperformed, again, reversing negative performance earlier in the year and actually starting to outperform on the year. So we kind of got validation for our positioning in that last 6 weeks. And it really kind of makes us feel comfortable about the year ahead, because although we're definitely going to get volatility, and I'm sure over the course of this year we'll have lots of conversations about how and when interest rate cuts are going to come, how many we get, et cetera, the markets are kind of obsessed with this. We don't really care. We think the dominant sentiment and environment will be one that is interest rates are going down, and what does that mean for asset prices? And we had a nice taste of what that market looks like at the end of last year, and we relatively outperformed. So we're pretty comfortable, and we think a lot of this sort of noise around when and how many is a bit short-term thinking. And I mean, we have certainly given a little bit of performance back in January, because markets did get a little bit ahead of themselves. The rally went a bit too far at the end of the year, but we're more than happy to see markets drift higher over the course of the year, again, as we get more certainty on these rate cuts. That environment is a lot better than a very sharp rally and then worrying about valuation. So yeah, like I say, it actually going through 2023 for the whole year, it felt pretty uncomfortable, but we did get the kind of outcome that we expected towards the end of the year. Our assets performed and the portfolios performed as we would want them to in that environment. So even though we had to wait a long time for it to arrive, we were pretty pleased with what happened last year, and we think it puts us in a relatively good position for the year ahead as well.
Actually, that reminds me of something that you said not too long ago, that one of your biggest concerns would be missing out on moments like the end of 2023 when markets rally.
Yeah, and it's a good point that I think I've said a few times on different videos and in different commentaries, that it's almost our base case scenario is that we're more worried about missing sharp rallies when they come than we are about another drawdown. And we had to wait for that through the whole of last year. But when it did arrive, the markets rallied really hard, right? They rallied really quickly. And it's not like you would have had time to jump in because you realised what was happening. And that's really the base case for staying invested all the time. And it's why we've not increased cash at any point, even though cash rates have gone higher, is because, when the markets go, they go. And if you're not there, if you're not on the train, it's out the station and you're not going to catch up. So, if that 7% rally that we had in bonds at the end of last year, if you missed out on that, even if you get in afterwards, the compound return on that 7% over the rest of this cycle is going to be significant, 3, 4, 5 years down the line. So we felt kind of validated by that, the fact that when that relief came, when the penny dropped to the markets they released that sort of pent-up energy quite quickly, and that is basically what we've expected and what we've been warning for maybe 12 months.
Thanks for that, Scott. So it seems like a lot of these risks that we've been talking about for so long, increasing interest rates, high inflation, it seems like a lot of those are fading. With the concerning situation and conflict in the Middle East, does this bring about some risks for 2024?
Yeah, obviously this is kind of broadened out and escalated, and it does have direct, as much as it's a horrible situation in Israel and Gaza and there's sort of broader risks around the Middle East, the markets are most concerned about the second order effects, particularly around inflation, because it could influence shipping rates and the oil price, and that could feed into inflation, and if inflation goes back up, then this whole nice scenario about interest rate cuts happening might go away. That's really the main market concern. But to kind of put a bit of meat on the bone, firstly, shipping rates, this is mostly because of the Houthi rebels in Yemen targeting ships through the Red Sea, which is obviously the gateway to the Suez Canal and sort of a third or more of shipping globally, a lot of the percentage shipping from Asia to Europe. And yes, container rates for those routes have definitely gone up massively. Lots of ships are avoiding that region, so it's an issue for shipping. But do we think this feeds into inflation? Not really. Obviously, someone somewhere has to pay more to move those goods. But it's not like in the pandemic. Firstly, the scale of the price increases is nowhere near the pandemic. It's sort of, they tripled and sort of tripled again, and we're not at those levels. But the main thing for us is that the global demand is not there either. In the pandemic, you had both a very sharp constriction in supply, and logistics and shipping, etc., and also a massive surge in demand of people from home consuming goods. So you've only got, to a lesser extent, you've got the restriction in supply, nowhere near like it was, but you don't have the surge in demand, right? There's not a big surge in goods purchases at the moment like there was. So there's no real driver for very fast inflation. So we're not necessarily convinced that that's an issue. What could potentially be is the oil price generally, okay? Because we're talking about the Middle East here, you've got Saudi Arabia, Iran, these are major oil producers, as well as some of the sort of smaller ones like Iraq in the region. And if this conflict does broaden out, particularly to include the US and Iran, aside from just the main, the geopolitical risks of a major war like that, the oil price would be the big one that could drive things. However, we were surprised by these data, to be honest. When you look back to the initial Hamas terrorist attacks on Israel, when people started talking about this potentially bubbling over into a broader conflict, the oil price is down over that period. And without a doubt, you couldn't deny that the risks have increased over that period to the conflict getting wider. Like I said, we've got the Houthis in the Red Sea, we've got these other Iranian-backed proxies operating in Syria, we've had serving US Marines killed in a missile strike. These are all potential flashpoints that are making it a riskier scenario, and despite that, the oil price is down. It's below where it was in those initial attacks, and it's striking to us that probably says more about slowing global growth and demand just generally, particularly in China, for oil, than it does about people worried about the chance that this escalates further. Because we do think the risks around the Middle East situation have increased, but despite that, the slowing growth in the global economy just swamps this sort of fear effect around the oil price, and the oil price is down. So we are, more fundamentally, we are watching it very carefully. We've started a lot of work on how would we reposition the portfolios, the day after the first, say, US missile strikes on Iran or something like that. It's kind of like, the analogy is, the day the Russian tanks rolled into Ukraine, what did we want to change in the portfolio? Did we have a portfolio ready to move into which we would be more comfortable with? So we're kind of having that prepared, but we hope and don't really think that we will have to use that. But that doesn't mean we're not discussing ideas to implement. And then, like I said, more generally, the inflation impact, we're just not seeing that. So if it doesn't go anywhere, if the conflict doesn't broaden out, then we think it's a bit of a sort of a sort of head fake on inflation. We're just not that worried about it.
Thanks, Scott. Now, 2024, it's a bumper year for elections. Now, the main ones that we may be concerned about, the US and the UK, are likely to take place at the end of the year. But really, the election story is something that we're going to be watching out for all of this year. Is that right?
Yeah, I mean, there's I think something like half the world's voting, those in democracies, half the world's population votes, and obviously a big chunk of those are sort of India and the US. But there are some consequential elections even before the US and the UK, but those will be the main ones. And some have already been, right? Like we saw Taiwan in January. That was a potential flashpoint because the candidate that China didn't like or doesn't like the most is the one that won, and there was this potential that it might flare up. That nothing happened there. The bark was louder than the bite from China. That seems to have settled down. But yeah, I think the main risk is really that we have such a long run-in to the US election particularly, probably the UK election as well, odds on that occurs in October, November, that there's this huge window for interesting things to happen, let's say, because the US, it almost certainly looks like it's a rerun of 2020 with Trump versus Biden. Everything that's going on with Trump, these court cases, he could be in prison, but the main criticism of Biden is around his health and his age and so on, so he might not be around. So there's just so much uncertainty that it's difficult to worry about at this stage, but that doesn't mean we're not going to worry about it, right? Because at any point, say Trump comes out with some crazy fiscal spending policies, the market is going to care about that. And I really think the biggest, both in the UK and the US, the biggest focus will just be spending plans, because as we saw with Liz Truss Kwasi Kwarteng, the market's very sensitive to fiscal credibility at the moment, because the cost of borrowing for governments has gone up undeniably, and even though interest rates are going to come down, they're not going back to rock bottom. So it's a bit like all of anyone who's paying a mortgage. You have to tighten your belt a little bit. You have to be a bit more sensible about where and how you spend your money, because your interest costs are higher. And that applies to governments as well. And if it looks like the potential people going in, or the potential winners of these elections, aren't going to be fiscally credible, if they come up with plans that look a bit silly, then bond yields are going to go higher, because the market's not going to be willing to lend to them. So this whole bond vigilante idea is a risk, but it's a very hard risk to quantify, because you just don't know what these politicians are going to come up with. So it's not really something that you can plan for, but it's something that you have to watch out for carefully. And at the moment, there isn't really that much difference between Republicans and Democrats in terms of big spending plans. There's obviously some big differences, like support for Ukraine, but it doesn't feel like there's anything like major economic reforms that would drive a big wedge between them. And the same is probably true in the UK as well. The Conservative Party and the Labour Party, there's no huge sort of difference in what would happen post the election. I think in the UK, the bigger risk would be to some sort of hung parliament. But where we stand in the polls today, even that would be a long shot for the Conservative parties, because there's such a commanding lead for Labour. So I suppose, in summary, we don't see it as a material risk, because it's hard to quantify, but there could be at any point, a sort of bout of volatility arising from some of this sort of political sentiment or policy announcements. And we'll just have to, roll with the punches, I suppose, as they arise over the course of the year.
Brilliant. Thank you for that, Scott. That's all we've got time for today. I hope you enjoyed this update and that you found it insightful. If you've got any questions, then please contact your financial planner. See you next time.